Well, hello. My name is Darren Whissen, and I'm the Managing Director of Investor Relations at Invito Energy Partners. And I have with me Steve Blackwell, CEO of Invito. And today we're just going to go through some high-level questions to help our viewers understand the dynamics of oil and gas investing a little bit better. First off, let's just start at a very high level. What are the different types of oil investments that people can get into?
From a macro standpoint, there's really the upstream, downstream, and midstream. Upstream companies are the companies that drill wells. Midstream are the pipeline companies that move the hydrocarbons around the United States through pipelines mostly. Downstream are the refineries on the coast. And so if you're a believer in those asset classes, you can invest through equities or ETFs. But if you want to invest directly as a retail investor, the most common way to invest is in the upstream side of the business. And the reason for that is the capital projects, the size of the capital projects for midstream and downstream are extremely high. And so when you're investing into the upstream side, there's really two forms of, you're either buying working interest or you're buying royalty interest. And in either one of those, you could be buying into a well that is already producing. So you're essentially buying into a cash flow, or you could be buying into wells that are to be drilled. And so the difference between working interest and royalty interest is essentially every well has a royalty rate on it. And that usually ranges from low side 12.5 to maybe 30%. So royalty owners don't pay any of the CapEx expenditures to drill the wells, and they don't pay any of the monthly operating expenses. They just get paid first. So a working interest owner is like an equity owner in a well. So let's say, for example, you own 10% working interest in a well, and let's say the well costs $10 million to drill. You're responsible for $1 million. So 10% of 10 million would be $1 million. You'd have to pay your $1 million of the CapEx, and then the monthly operating expenses, you would pay your 10%, and then you would receive 10% of the net revenue. So the math kind of looks like this. Let's say there's $1 million of revenue to pay in 1 month off a well. Let's say that the royalty rate is 20%. 200 grand is coming off the top, going to the royalty owners. And then the 800 grand is coming over to the other side of the ledger, paying the operating expenses. And then that net revenue is what gets distributed to the working interest owners in whatever proportionate share they own.
Only working interest is entitled to the associated tax benefits with oil and gas drilling programs. So walk us through what are the different types of associated tax benefits that come on the working interest?
So yes, to the upfront tax benefit. So royalty interest or buying into producing wells does not give you the upfront tax benefit. So when you acquire working interest in a well that is about to be drilled, a new well, the big deduction on the front side is called the intangible drilling cost deduction, which is IRC 263 of the code. And essentially what that is the IRS is saying, okay, any expense that goes into the ground to drill a well that does not have any potential salvage value when the well is finished producing is classified as an intangible drilling cost. And the IRS through 263 says you can take 100% of those and write those off in the year of investment. And intangible drilling costs are typically 75 to maybe 85% of the total cost of a well. So how that would translate is if I'm a client and I put in 100 grand, and let's say the IDCs are 80% for the first year, your K1 or your loss for that particular year will be 80% of your $100,000 investment. So you'll have an $80,000 loss from the intangible drilling cost. So that's the upfront, the main deduction. Now the remaining costs are tangible drilling costs. So just the exact opposite, anything that has potential salvage value. And that's again, 15 to 25% of the total cost of a well. Normally you would amortize those over a 7-year period. But with the passage of the Big Beautiful Bill and bonus depreciation going back to 100%, you can now accelerate those. And you'll either take them in the initial year and combine them with the IDCs, or you'll take them in the following year. So year one after the first year of investment. So those are the two big upfront deductions.
So you talked about that tangible drilling cost being possibly in the current year or possibly in the following year. I think that needs a little bit more clarification. What is the scenario in which you would take both the IDC and the TDC in the same year? And what would be the scenario in which you take the TDC in the following year?
Yeah, so the only way you can take bonus depreciation on the tangibles is if the wells that you are investing into are completely drilled and made capable of production in the same calendar year. So for example, like our fund that's currently open today and is closing December 31st, the wells are not obviously going to be drilled before the end of the year. So in this case, you'll take the tangible depreciation, bonus depreciation next year. We always have a second quarter fund, which is called the Opportunity Fund. And the opportunity is we'll target investments into wells that get drilled this year so you can combine the IDCs and the TDCs. And so those clients are going to get probably a 90 to 95% deduction for 2025. The clients in the fund that closes at the end of the year are going to get 75 to 80%. Now, you don't lose it. You just get it the following year.
Yeah. So effectively the same total deduction is just whether it gets spaced out into all condensed into 1 year or spaced out over a year, just because of the timing of when you have to finish the drilling and casing of those wells. Let's talk about some of the case studies that can be used for these programs. So clearly, offsetting ordinary income is the big driver for those intangible drilling costs. So walk us through just a couple of high-level scenarios that work for that.
I mean, the most common one is we get a lot of clients. As you know, our clients come through advisors. And so a lot of the clients that come to us through advisors are high-earning W-2 clients. So whether that's a doctor, we get a lot of tech people. So that's kind of the easiest low-hanging fruit, right? If you're a W-2 employee and you're earning a significant amount of income, we're a 506c offering, so it does have to be a accredited investor. But I would say the average W-2 client that's coming to us is probably, 400,000 or 500,000 or more. They have very limited in what they can do to offset that tax bill. So that's kind of the easy one. Of course, any business owner that's generating a lot of ordinary income is another scenario we get a lot of. And then, of course, we get a significant amount of people using oil and gas to tag along with Roth conversions. So as you know, when you convert your Roth, it triggers a bunch of ordinary active income. And so if you have the ability and liquidity in non-qualified accounts, you can combine it with an oil and gas investment and either minimize or completely eliminate that tax liability. And then you could in some scenarios, they're getting their money into a Roth essentially tax-free and then getting an investment alongside of it. And so those are some of the most common scenarios. And then, of course, any of the one-time events. You sold a business, inherited some money, stock options, anything along those lines are some of the most common case studies that we see.
Okay. Talk us through what a discounted Roth conversion is.
Yeah, so a discounted Roth conversion is essentially you're investing. So a lot of it's done through self-directed IRAs. So they're putting money into a self-directed IRA. They're then invested into some sort of asset that really has two components to it that you can take advantage of, which is the lack of control and the lack of marketability. So let's say, for example, your self-directed IRA is invested into some sort of LP that's in let's say a multifamily syndicated deal, just to make it easy, right? So sitting in it as a limited partner, you're not an active manager. So if you go to convert that over to a Roth, you have to because it's not actively traded, right? You have to go get an asset evaluation done by a third-party firm. And they're going to give you two discounts, look to give you two discounts when you do the evaluation. One is the lack of control because you're in an LP position. You have no control over the investment. And the other one is lack of marketability. Most alts are not marketable. So those two are commonly at least low side 30, but sometimes as high as maybe 40, 45%. So to make the math easy, if someone converted $100,000 to a Roth, they got the asset valuation and it discounted it by 40%. Now you're only paying tax on $60,000. And so 40 grand is already just moved over tax-free. And now you can look for other strategies to minimize that other $60,000 of taxable income.
So as it relates to an oil program, $100,000 investment is eligible for that possibly 40% discount, move it over, and then they would get tax-free cash flow to the life of the fund.
Yep.
We've been talking mostly about offsetting ordinary income, but obviously oil programs are eligible to offset passive income as well. Can you talk about a little bit the difference between what is required to go offset ordinary versus offsetting passive?
Yeah, so the only thing you have to do to offset ordinary income which is what makes oil and gas so unique. Let's be honest. This is a completely passive investment. So typically you would be limited to offsetting passive income. But there is an exception in the passive active loss rules, specifically for working interest, that allows you to take this loss and offset ordinary income. What you have to do is they're all set up the same way. They're all set up as limited partnerships. You come into the fund as a GP. So you sit in a general partner position, so an at-risk position, while the wells are being drilled. And then most of them are set up the same way in terms of you convert to a limited partner, and that language is automatic and written into the partnership agreement. And you convert to an LP once the wells are drilled, which will typically happen between month 12 and maybe month 16. And so if you want to offset passive income, you would come in as an LP. If you're looking to offset ordinary income, you'll come in as a general partner. And what's interesting is you can come in as a GP, take the upfront loss and offset ordinary income. And in some cases, there's not a lot of clients that have this scenario, but as the income comes to you, right? So another question you probably would ask is the income is taxed along the way as ordinary income, but it's taxed at ordinary income rates, but treated as passive income. So not subject to self-employment tax. But if you have passive losses stuck on your books, your returns that you're not able to utilize, now as this income comes to you, you could use that to offset those
passive losses.
That doesn't happen very much, but we've seen a few of those cases. So you're literally getting the benefit on the front and the back, which is pretty nice.
Some investors might be concerned about investing as a GP and what that means from a risk perspective. How can their risk against unlimited liability be mitigated through an oil and gas program?
Yeah, so just to understand how it works in the business, right? In the oil field, essentially every well has an operator of record. And so most of those are larger companies, especially what we invest into. So the operator of record always has their insurance policies in place. And then most operating companies are not the companies that come on location. You've seen the big rigs that drill the wells. That's a third party company, a rig company. And then, or when the well's being completed, that's a service company as well, which is always a large, Schlumberger, Halliburton, Liberty Energy, et cetera. So there's the insurance policies of the operating company, the insurance policies of the service company. Those companies will execute a master service agreement between them, basically saying you're responsible for your employees, I'm responsible for my employees. Then once you go below that level, you'll have the insurance policies, in our case, of the fund, right? So if anything were to ever happen on location, and again, we're onshore, not offshore, right? Offshore is a totally different animal. Someone would want to have to go through an operator's policy, a service company's policy, go through our policies, and then want to go chase down individual investors. And so is that possible? Technically, yes. You have to sit in that position to offset ordinary income. Can I tell you I've ever heard of a scenario like that? I cannot tell you that.
So next, let's talk about the wells that you are contemplating and looking to invest in. Let's start with a high-level overview. What does the underwriting process look like as you consider a well for investment?
Yeah, so the discipline in our business that underwrites wells in terms of the reservoir engineer. So a reservoir engineer's job is to determine what is the well going to cost to drill, what's it going to cost to operate, and then more importantly, what does the production profile look like of that well? So they're going to go in and create a data set, right? So they're going to go in and use software, and they're going to go, if I'm pointing at a map and here's a map with potentially 3 wells we're investing into, they're going to go and they'll start with a 3-mile radius around that location, and they will look for wells that have already been drilled in the same formation in that area within 3 miles so that they can grab the data of cost, the production profiles, the operating costs, and dump that into a software. And so however they create their data set, the closer that information is, the more de-risked it is, and the more they have, the more de-risked it is. If the further away they have to go for data, the more risky it is. But that data set is what will determine those three KPIs, if you will. What's the production profile look like? What's it going to cost to drill it? And what's it going to cost to operate it?
Great. So if that's what they're looking at to underwrite it, then you're going to run it through a financial model to understand, based on the total production, what we think we're going to ultimately receive as a GP investor.
Yeah. So you have to take all the oil and gas underwriting, take those production profiles, tie it to a commodity price, take those cash flows, dump it into a financial model, add the loads from your PPM, which is very important. You got to add the fees from your offering, and then you get the kickouts, right? What are the two metrics we pay most attention to are what's the time for return on invested capital? So how long does it take the clients to get all their capital back? And then what's the total return? We'll look at the IRRs and we'll look at annualized returns as well. But we are really focused on total return and what's the ROIC? What is the time frame for return on invested capital?
Sure. And since Invito fundamentally is doing non-operating working interest, we are participating on a fractional share with multiple operators, multiple wells. Walk us through that process of how you ultimately acquire those fractional shares of ownership in those wells.
Well, there's many different routes, right? There's the traditional routes, which are just industry contacts, right? And so everybody that chases non-op working interest will do that. Additionally, for us, most states other than Texas, which is a very mineral owner friendly state, have what's called forced pooling provisions. And so a very common question we get is, like, for example, we just got into 4 EOG wells. Well, EOG is a massive publicly traded company. Why would EOG sell you working interest on a well? EOG does not sell a working interest in a well. EOG doesn't care about us, right? We are acquiring the minerals that have not been leased to EOG, which is why it's called non-op working interest. And so what's interesting about oil and gas is the operator of record rarely owns 100% of the working interest. So there's this whole secondary market of what's called non-op working interest that trades hands. And again, you can acquire that through industry contacts, through marketed transactions, or you can do what we do, is where we generate the majority of our business, is we go into areas that are called forced pooling states. So once an operator of record owns over 50% of the working interest, they don't have to lease up every mineral owner. In Texas, you have to lease up every mineral owner before you can hit the drill bit, can hit the dirt. And just to give you an example, one location, you could be in West Texas, you could have 4 mineral owners. You could be in East Texas, you could have 400 mineral owners. And so the fact that you don't have to lease everybody up is a big, takes a lot of work off the land department. And so once they get to the acreage level they want to control, then they will file a forced pooling permit to say, basically, here's where we're going to drill a well. Here's where we're targeting. Here's all the details of the well prog. And then it'll list out all the people that have not been leased up yet, the people that they're trying to force pool. And we scrub that data and we put it into usable format. We underwrite in the areas we like. If it passes our financial model, so we probably underwrite 100 deals a month, maybe 8 to 10% pass. And then we pass it along to an acquisition team to go acquire that acreage or those minerals. And so we could be acquiring the minerals directly from, and we're not acquiring them, we're leasing the minerals. So we could be getting that lease directly from the mineral owner. It could be sitting in a trust. It could be another oil and gas company. It could be another mineral company. It could be any one of those. So, and we're basically stepping in and saying, look, EOG's filed a permit to drill a well. You're being force pooled. Here are the terms you're being offered. We can offer you better terms.
Okay, great. So the engineering team is evaluating wells that they'll possibly acquire at the end of this by the end of this calendar year, or possibly into the first part of next year. What does that landscape look like? Where are the wells fundamentally are you looking for right now?
So today we focus on the oil basins. Mm-hmm. So in other words, what we are not doing today is participating in the pure gas plays. So like the Marcellus up in the Northeast, or some of the big pure gas plays in the Northeast, the Haynesville in East Texas. We aren't participating in the pure gas plays just because we're not comfortable with where natural gas prices are. We think you need consistently $3.50 or higher in MCF to make money on a retail level there. So the oil basins are really the Permian Basin in Texas and New Mexico. That's the big one everybody's heard of. Mm-hmm. But the Anadarko Basin in Oklahoma is another big play that has a lot of different benches in it. The Bakken Shale is a very well-established play at this point. The DJ Basin in Colorado, the Uinta in Utah, the Niobrara up in Wyoming is another area. But for us, we have most of what we've been participating in so far has been in either the Anadarko or up in the Wyoming and the Niobrara. There's a couple different benches up there as well. We've participated in some Permian Basin. Everybody loves the Permian Basin. The problem with the Permian Basin for us is everybody's overpaying for the Permian Basin. So we stay disciplined to our metrics. We're not going to overpay for a deal. And we've participated with some Uinta Basin wells and some Bakken Shale wells. But recently it's been the Anadarko and up in Wyoming. We like the DJ Basin in Colorado. The regulatory environment is not very friendly up there, so we're a little skittish on participating in a well and then the permits being held up due to regulatory issues up in Colorado.
So one of the things I want to talk about is how you manage risk. And from an investment advisor's perspective, one of the number one concerns is preservation of principal. I do not lose the principal. So how does Invito approach this idea of risk management?
Yeah, so we know that. We know the mandate when you raise capital through retail clients and advisors is principal protection. So essentially what that means, there are a significant portion of drilling prospects you can't participate in. And so this isn't a defined term in our industry, but it is a common term used that really just means there's tier 1, tier 2, and tier 3 acreage, or in other words, tier 1, 2, and 3 drilling locations. And that will, inside that is tier 1 in terms of risk and in terms of return profile. But let's talk about it purely from a risk management standpoint. And so essentially, tier 3 and 2, specifically tier 3, let's start there. If that reservoir engineer is going in and looking at a map, and when they do that 3-mile radius, there are going to be no other data points within 3 miles, right? So in other words, no other wells have been drilled yet in that area that you're targeting for investment. So you're going to be going maybe 5, 10, 15, 20, 25 miles away. And so the risk profile when you are in terms of returns are literally dry hole to a fantastic well and anywhere in between when you are into a prospect that has that kind of a risk profile in terms of the data is that far away. So the probability is extremely, whatever the engineer is coming up with, the statistical variance can be extremely big or literally a dry hole. So you can easily lose all your capital there. Tier 2, same location. You're looking at a 3-mile radius. Now we got 4 or 5 data points. In other words, there are 4 or 5 other wells that have been drilled, right? So now, depending on what the production of those wells look like, you're not participating probably in a dry hole because you can see that there are producing hydrocarbons from that formation. But again, the statistical variance can be significant, not certainly like a tier 3, but because you don't have a lot of data, right? And so you could get into what's called an uneconomical well. In other words, it has revenue, but it doesn't pay its own expenses. Or it produces, covers revenue, but it doesn't pay out. Maybe it only gets to 60, 70 cents on the dollar. And again, it could be a fantastic well and anywhere in between again. So again, tier 2 and tier 3, again, easily can lose your money or not hit a return. Principal protection could be a problem there. Tier 1, that same location, the engineer is going to go in and going to probably see at least a dozen data points within 3 miles and maybe a couple dozen data points within 3 miles. So now the data set that they are producing to use to determine the cost to operate, and production profile should make that statistical variance not large. And so we focus on the tier 1 stuff because that is the only way we can look our clients in the eye and go, look, this is how we truly believe we can protect the principal. Because we should not be participating in a well, certainly not a dry hole, or a well that doesn't even pay its own expenses. And even in tier 1, you really shouldn't even be participating in wells that are meaning don't even reach payback. And so if we have 10 wells into a fund in a tier 1 area, all 10 wells are going to produce and pay out. And so now to what level they pay out, you can't guarantee that. You can't guarantee the upside. But if your mandate is to eliminate and protect principal, you just can't participate in tier 2 and tier 3 properties. Certainly tier 3, right? You could easily maybe mix in a small piece of a tier 2 if it had a higher upside, but for the most part, you're going to be tier 1. And that's why we do non-operated working interest. Because today, the vast majority of the tier 1 acreage is already owned by the larger E&P companies. And so that's why we target fractional working interest in tier 1 acreage under the well-established operator. So from a risk management standpoint, it's really tier 1 acreage, meaning lots of data within 3 miles, lots of seasoned production. When you're in an area like this, the infrastructure is already in place, meaning the roads, electricity, the disposal wells are already in place. We don't leverage the fund, so no debt, which juices returns, but makes the risk go up extremely. And we want multiple wells, so we don't have a lot of concentration in the fund. And then we also underwrite the operator. And really what that comes down to is, what is their balance sheet? What is their capital source? Everything that we invest into is a horizontal well. Average horizontal well is $8 to $10 million. You don't want to participate with a smaller company that may not have the capital to either drill the wells or they may poor boy the operations. So for us, it'll either be a large independent, publicly traded company or a private equity backed firm. So that's really how we manage the risk. And it's, again, that never guarantees the upside in any investment, right? Certainly not in oil and gas. But what it does is we should not be participating in projects and wells. If we have 10 wells, if you have 10 wells and you just have one that doesn't produce, it's going to kill the performance of the fund. And so that's how we manage the downside risk.
So let's talk about DrillCo 2025, which is a $30 million fund. Approximately how many wells will go into that fund?
You know, on the low side, I would say probably 10, but I would say it's going to be end up anywhere from probably 10 to 20 wells. And that'll depend on how much of the 30 million we raise, because the benefit of doing what we do is we don't have to, because we're not an asset specific fund where I have to have $30 million to participate in what we own. Regardless of what we raise, we can put it to work. So the more we raise, the more wells that'll be in there. So, but on the low side, you know, 8 to 10 wells.
You think most of that'll be in the Anadarko, maybe some exposure to Permian?
No, I think most of that right now will be the Anadarko and up in the Wyoming and the Niobrara. So we've already have for that fund already, we have, I think, 4 wells in the Niobrara up in the Wyoming area and 2 wells in the Anadarko already taken down.
Right. Do you already know which operators will be taking down those wells?
So 2 of those are EOG, 2 of those are Devon Energy, and I forget the other ones off the top of my head.
Okay. Yeah. So let's do a summary of what the DrillCo 2025 fund is. Let's just walk through the metrics for an investor. What does that look like?
Well, as I told you, when we are underwriting, and we're underwriting a lot of deals, we're really paying attention. So we're going to dump all the fees, and we're going to look for a return on invested capital by year 4. So we're looking for the client to get all of their money back, not including the money they made off the tax benefits, but all their money back by year 4, cash on cash. And then we'll hold these open for at least 5 years, but we'll look to exit somewhere between year 6 to 8. So we're looking for about a 1.75, 2x return total over that time frame as a minimum for our minimum metrics when we underwrite. So,
and that metric is regardless of, does not factor in the tax benefits. Well, that is purely an economic play.
So the two in the executive summary, when we're targeting a 2x, it'll include about 25 basis points from the tax returns.
Okay. Yeah. Okay. And the fund minimum, like what's the investment minimum for that?
50 grand.
50 grand.
Yeah.
Have to be in by the end of the calendar year to get the tax credit for this calendar year, and then the TDC falls in next year.
Correct.
Obviously, what's the delay until production starts and they start to see cash flow?
So typically we tell everybody distributions will start by the 3rd quarter after the fund closes. So DrillCo 2024 is heading that time frame. The 2 funds before that were 2nd quarter. This particular fund I anticipate to be probably at least we already have wells in inventory. 4 of those wells are going to be drilled this year. And so I would anticipate that we'll have cash flow in the 2nd quarter to distribute, but we always say minimum 3rd quarter.
Okay, great. Thank you.
Thank you.